There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, traders, investors of the world. Today is, let me make sure OBS is working okay. Today is the 30th, last Saturday of July. This is the weekend software strategy and macro session. My name is Steve Vetterl on the mic. I am the risk manager for AP. I try very hard to have these discussions be as high level as possible. Getting into the weeds these days seems like a futile endeavor. So we try to keep it real big picture and talk about all the great things that you guys want to do. Now, one thing I will suggest, since today's cast is going to be a little shorter, and I'm doing that because I want you guys to take a look at what I did on Tuesday. So, shameless plug here. I put out a I just did an entire presentation on my process start to finish. Didn't get into some of the details of the other softwares I use, but just keeping it simple from at least a big high level process of what I do in terms of looking for individual trades. This process is a little bit more geared towards equities. But as far as understanding what's going on in the markets and having sort of done an analysis or a little bit of homework, if you will, on what's taken place, that process should not change, in my opinion. It's really just a matter of being, not necessarily really climbing through the weeds and all the news that breaks and how that affects everything, but at the very least, the highest level of what central banks are doing, how that's affecting money supply, how that's affected currencies, things like that. So I showed that piece is up on both the YouTube channels and the Vimeo channel as well. Check it out. So, looking at the finviz.com screen, I am continue to be amazed at how much traders are all like, "Hey, I've never seen this before. I don't really know." This is one of the best dashboards in all of the web, period. In terms of finance, these guys have won a mass load of awards because of the simple fact that they put everything in one spot and it's exceptionally well laid out and very consistent. So I always look at this every week, even though I don't trade commodities, used to trade energy, but I need to know kind of where the space is for all these different areas of not only sectors, but also different types of trades going on, because they all affect the credit markets, what eventually will affect currencies, right? Sort of like the dog wagging the tail. But I think the prevailing sentiment in the marketplace, if you've been living under a rock and just climbed out, or if you woke up from a long coma, I would say welcome. It's a great trading environment. You should get involved. But the Federal Reserve raised interest rates 75 basis points. And so essentially 3/4 of a percentage point. I think they're done. I could explain that on and on, but that's kind of my opinion. One thing that I did note that Chairman Powell said that rates have gone to neutral. Okay. So essentially, we're at like 2.25, 2.5. Keep in mind, this is the Fed's overnight lending rate to banks. It's not the interest rates we pay as retail or commercial customers, but it is the rate that sets almost everything else, right? Margin rates on your accounts. That's what's called the overnight lending rate from what banks are charged by the Federal Reserve to borrow, and that has gone up significantly. So, what does that mean? It means the cost of capital is now higher. Okay. Um, so, the interesting thing that they said is that the range that we're in had gotten to neutral. And that's right in the range of what we think is neutral. So the bond and stock markets have rallied substantially. If you haven't looked at it, we've had just an absolute rip, which I talked a fair amount about. And my my sentiment was is if there's any sort of hey we're blowing the whole 75 now and we're done, you're going to see an absolute rip. So there's no way I'd want to be short any of this market in any type of trading that I did, right? So I know a lot of you trade NAS-based stuff, S&P and Dow 30-based stuff on the MT4 platform. Regardless of the broker you use, I mean, literally any pullback this entire last 4 days, it's been met with an absolute face ripper, right? So this is a great example, which I'll detail, of what's called one-time framing up. Okay. So if you trade any of the indices based stuff or equities or ETFs or, any of the sort of pairs or Forex stuff based on indexes, which I know a lot of people do, this is not one of those times in the last 3 days that your algo or any type of manual trading you may be doing, you ever want to step in front of the train, right? This is when you want to jump on the caboose and ride the wave higher, right? It's just much easier going with the trend. So I'll illustrate some of that on the charts, but um, I think the problem is that we're not close to a neutral rate. And I think this is sort of the sentiment of the market. And I think that as much smarter brains on Wall Street than myself and globally begin to digest this over the weekend, they're going to be like, well, we're really not close to a neutral rate, right? So rates 2.25 to 2.5, that may be neutral with 2% inflation, but it's an extremely accommodative rate with inflation at 7 and 9%, right? So the cost of borrowing is a function of interest rates and the rate of inflation during the term of the loan. So inflation reduces the cost of borrowing, as it is sort of the real interest rate, right? That's what matters. So the money in your savings account is decreasing by about 1% per month due to inflation. So you're incentivized to spend it and borrow more. So I think the concern is that, like, I don't know, well, business to consumers, they don't borrow at that 2.25, what they call FF rate, Fed funds. They pay a spread, they pay a higher rate. But even at this current spreads, the real cost of money is still extremely cheap. So everyone is incentivized to borrow and spend, fueling inflation. And if you look back over previously highly inflationary economies, certainly the mid 70s comes to mind if you're an older American, the Fed had to raise rates way above prevailing levels of inflation in order to kill it. So while I do think that, inflation will be coming down soon, I've been talking about it, is there's no inflation in some of these areas of these commodity charts I'm going to show you. I don't think we're anywhere near neutral. So, Steve, what does all this matter and why do I care? You care because right now, if my thesis is correct, the cost of capital is still pretty cheap and everybody still is incentivized to borrow for whatever purposes, right? And this could be building a semiconductor foundry, right? Maybe it'd be a little easier in this country if Biden signs the chip bill that's on his desk in the next couple of weeks, right? So the cost of capital for something like a project like that, which is a huge capex project for any company, um, you still can get some pretty cheap money to do that, right? So building mortgage rates, obviously, most people would disagree with that. they would say, well, hey, mortgage rates are a lot higher. In some cases, they've doubled off the lows. But the lows that we saw in mortgage rates was an unsustainable low. I mean, if anybody would actually use that as some sort of round of comparison, I think you're just a bit off kilter on that. So, in highly inflationary economies, the Fed had to raise rates much, much higher than where we are now, and to maintain at these levels for extended periods. So many are puzzled to understand how the Fed believes that we're already at neutral, right? It's almost like somebody got to them and said, hey, global equity markets, for the most part, the developed markets, they're off 20, 25%. If you continue to raise rates, that's just going to kill whatever demand there is. So my sentiment shifted a little bit. I'm reading up on it this weekend. I think I'll be in maybe a little bit of better position to build on that. But I think that's enough to sort of digest at this point. Just keep it real simple, right? As I think I shared with you guys a couple of weeks ago, I started my son on a financial journey. I've given some of the links on the Telegram channel to different types of books to start reading. And I always think that any type of investment management, trading, what have you, career, has to be on, it has to start from, in my opinion, macroeconomics. You've got to understand how things work generally, right? Before you can start sort of tinkering around with them. So the next book I bought for my son is what's called Narrative Economics. It's by Robert Shiller. So if you don't know who Robert Shiller is, you can Google him. I guess I could put a link up to this book in Amazon. But Shiller won a Nobel Prize for economics, and really just about how stories go viral and drive major economic events. Okay, now this particular book, actually, let me just do this. I go to the images instead. There it is. So this is the book here. It's called Narrative Economics. It's actually a really good piece. This is perfect. And by the way, this is a story. Wouldn't you know that we'd fall in this? This is a story by James Grant. So him, along with Robert Shiller, Tom DeMark, these are the guys that I sort of follow a lot. At least in terms of big level economics. James Grant runs the Grant Observer. It's interest rate. He's a guy you see on television looking really skinny. Wears a bow tie all the time. He's actually a super smart guy. His stuff, along with Tom DeMark's, the tendency to get a little deeper. But honestly, with this book, why can't I find a damn picture of this thing? Let's just stay right here. I like when somebody's like, "Hey, read this book," I'm always like, "I want to see a picture of it." So here you go. Narrative Economics, Robert Shiller, good book. Again, with anything I recommend, and most of the stuff you're going to read on this, one of the key points I always try to push is you don't need to absorb every single word, right? Just try and pull, this is how the speed reading people teach, but just try and pull common themes out of a paragraph, right? I always say if you can come away from anything with a couple extra nuggets, in some cases a handful, you're much better off. I don't care if you're sitting at a Grant Cardone presentation or a church, a recital. I mean, there's something you can pull away from any kind of speech or self-help. I think that the problem with a lot of people is they spend way too much money on this type of stuff, self-help books, this and that. As many of you know, I'm a James Clear fan, Atomic Habits. I think it is one of the more impactful ones I've ever read. Um, and there's a couple other books surrounding that, and I follow Ed Lattimore. These guys are just no BS, solid advice. But at some point, you have to get out there, take action, right? You have to put an action plan together. This is what most people lack, and and that's not me being harsh. It's just reality, right? You always get a full, in most cases, a brash transparency from me. But the the path that I'm taking many of you down, and I've gotten a whole bunch of DMs on this stuff, is just a path that I wish somebody had pounded in my head 20 years ago. I'd be that much further ahead. I mean, I don't really have any complaints. I'd be that much further ahead. And I probably spent too much time reading too many self-help books, and then my brain just got mired in, um, all this action, right? And I think maybe thank the good Lord that I was a type A, no BS, just cut through the crap and get it done personality, type A type driver. I just sort of powered through that. But, I had sort of like brain fog as my plan was unfolding. And, I just think there was other decisions I could have made there. And, I never lost a large amount of money in the early days trading, right? But at the same time, I was so conservative trading, I could have made a lot more money, right? So, I mean, I actually took a completely different route. I saw all kinds of people blowing up all the time. It wasn't necessarily trading Forex, it's just trading options and equities. And, things were just absolutely bananas from 2000 to the crash in tech in '03. So it really sort of made you step back and think. I watched, and I was privy to many, many trading accounts, and I would just look through them, and it was just random lunacy as to why many of these things were purchased. Um, but the book itself here, I think, is good because the narrative, right? Narrative economics, the narrative has absolutely been taking center stage the last few years, and where prices of different things go based on events. So I think it's, from a risk management standpoint, it needs to be a new piece that you're putting in your arsenal so that you can teach yourself, as I've talked about a lot, stay away from the mania, right? In any case. So, I told you guys I'd recommend the next book in the process. Let's take a look at the markets next. So July 31st here starts tomorrow, last day of the month. Let's look at the calendar here. Last day, first full week of August. Just understand this, in, I don't know, let's just say a good chunk of this country, right? This essentially is the last 2 weeks before many have to get back to school. Okay. And this isn't necessarily geared towards any particular grade, but people are sort of back in the, hey, summer's over and it's back to work. The next 2 weeks could have quite, hell, for that matter, the whole month of August could have quite thin volumes, right? So just know that now most of the events are out of the way. Our fellow policymaker idiots in DC will be on vacation for a chunk of August, right? Fed's on recess, so a lot of people are just, going on. Just know that volumes are thinner, right? So people say, well, hey, volumes are thinner, right? But guess what? There could be a lot more volatility when there's not a lot of trading volume, right? So just know, walking into the next month or so, um, that's the case, at least until we finish the Labor Day weekend in the beginning of September. So next week, bank holidays on Monday in a couple of countries, actually Sunday and Monday for that matter. RBA statement, employment change, and then we've got U.S. non-farm payrolls. This is the big one. For what it's worth, I don't trade in front of red folder events. I don't care what the event is. I just don't trade in front of them. Now, if it's something small like, employment change in New Zealand, I don't really care about that as a U.S. trader. As long as I'm not trading a New Zealand dollar, I'll still trade around that. But just the bigger events, I typically just don't trade. If anything it has to do with any central bank talking about anything, right? But this one actually may start to take, I don't know, a bigger role So it'll be interesting to see what happens here, and then the unemployment rate, as these things tick up, puts pressure on wages, right? That's puts pressure on wages to go higher, which we've seen. A lot of companies have been pressured to pay employees more. I think that's a component of a lot leaving the workforce, the pandemic, general laziness by a lot of younger folks. No offense, but a lot of you guys don't have jobs that you probably should have, and you can't make all your world on Instagram as a influencer, right? There's other ways for employment. So the this could probably begin to take a little bit of a more prevalent stance as far as numbers. Okay, FinViz. Steve, you're always talking about FinViz. Yes. Let's take a look at what's going on. I like big picture, easy to compare to each other stuff. So Dow, S&P, NASDAQ, Russell, so small caps. Then obviously European markets, primarily focusing on DAX as a broader market measure. You've had total rips in S&P, NASDAQ, all this stuff, right? No surprise. Market seems to think the Fed's done. And if that's the case, cost of capital still low. Maybe companies could still do pretty decent. In terms of corporate earnings last week, we had a number of hiccups, strange stuff came out of Walmart, right? Amazon did really well. And then there was a lot of other earnings out that a couple of common themes were they're all spending more for their stuff, right? Just because everybody seems to want to raise prices on stuff. When reality is if you start to look and notice, by the way, these are just daily charts of the energy space going down with the exception of nat gas. Okay. Notice how gold's totally face ripped back up to the T1780 area in terms of the charts. Silver just boom, big vault too. Copper's coming back up. I'm not sure why a lot of these charts started to tick back up, as you can see. Many of them were really, really low. And look at the price of cotton. Why would clothes prices be really up when the price of cotton's dropped almost in half of where it was last quarter? I mean, look at lumber. All these, and another thing as far as risk management, I know I'm going to piss a few people off with this statement. Don't ever make the mistake of basing any kind of real estate purchase off of the local realtors association person that's on TV. Okay. I'm not going to say it again, but please listen to this because I'll tell you, the vast majority of them are talking heads. All they care about is just continuing to pump prices higher. They never came on TV in late 08 and told you that prices in some areas were going to get absolutely crushed over the next 2 years, in some cases 3 years, to level out, right? So they have a vested interest in you continuing to buy and sell property. It's that simple. People aren't going to buy and sell property unless they think they're going to make money, right? But I am of the cut of the cloth, as I was telling these two guys I was out with last night. We had a couple of beers at the local brewery with Derek Alexander and Desant Estandi. He's a developer of Variable. Derek's big builder at Auvoria, as you guys may know. These guys do want to do some more real estate purchasing in Florida, as do I. But, I told him we'd rather be sifting through the ashes than purchasing at the highs, right? So if in fact real estate's so hot and the builders, which have cooled off as well, why is lumber at a 52-week low? All right, so credit markets way back up. Again, if you look at the 10-year, focusing primarily here, this is one of the bigger components of 30-year mortgage rates. We hit as low as 116, know where we started the year off at, right? Now here's where we've jumped back. So we've come back quite a bit. We've essentially erased the decline of the second quarter. Let's just say beginning of the second quarter, had a big drop, then we rip right back up. If you look at it in terms of a weekly chart, we're still down a ton, right? Back to where we were in the late summer of 18. But now we're right back to where we spent a fair amount of time, right? People are like, oh, mortgage rates are way up. Well, they're coming down now. As markets rally in price, and the yield actually drops. So it's an inverse effect on that. All right. Let's talk about some currencies. So no surprise, right? If things are better and there's less movement into safe haven stuff, we would expect the dollar to pull back, right? We've pulled back 2 full points on the highs that we saw, which I don't think a lot of us would really see this high. Keep in mind, I had a pretty deep discussion about how this is not good for U.S. companies. We saw a fair amount of that warning from Walmart and how the dollar has been clobbering their overseas business. It's not that their businesses may or may not be growing just in terms of sales volume, but the conversion back or the denomination back into dollars for a U.S. based company, they have to pay much higher conversion rates, right? They get less money as opposed to maybe when the dollar was back down, in the 95 area. And in the big picture, just want to look at monthly on this, the way we can see like 20 years. Let me just increase this. There we go. So look where we are here. Came right back up and just absolutely ripped to the first slingshot in the decline. This was during a crushing period in tech stocks, as I had talked about earlier. This period, because a lot of times when you have, at least last month, or I should say all month of July, an exacerbated move into another area, you will usually get what's looking to me like a island reversal. Not as disconnected as you'd think, but maybe if we look at a weekly chart. I mean, we were one time framing up. 1, 2, 3. Now down, this is just a weekly chart. This is what I call analysis on the fly. Things start to rally in a lot of the other asset classes, and then it's sort of a risk on the trade. This area is going to just probably yield back. I wouldn't be surprised. This was a total breakout, by the way, here. It's just a textbook cup with handle break. We've already come back to it. So if you didn't understand the power of a cup with handle as far as a launching point, hence this huge green candle you see right here. And what was that date? Hard to see here. You know what, actually, let me just... All right, so a US dollar, and this is a, just double check real quick, this is a weekly chart we're looking at. So we've had 2 weeks of reversal. I would expect us to maybe sort of level out here, pending anything all crazy coming out. Geopolitical with Ukraine. You really haven't heard a lot of the news about that. But then the euro rallying back, we got the parity. If you hadn't heard any of my previous casts, we hit parity, which is crazy. It's like if you're a U.S. resident, you want to like travel to Europe, have some fun, take some pictures for me, give me some Belgian chocolate while you're over there. But we're looking at the euro pulling back. Most currencies obviously in major land are down as the dollar's been up, right? So I would expect that to continue to maybe even trade sideways on that. Remember, I always say, I could be wrong. So you always want to be looking at what would disrupt your plan. Let's take a look at it. By the way, this is just equities real quick. S&P, pretty big area of break. albeit this was almost a moving line. Last couple of days it was down here, and then it actually took itself up. So we're moving now, where this is one of the first times on a daily chart since the 13th or 14th of June that we're basically close to touching a Bollinger Band, right? So we've gone from one extreme, from a standard deviation or a stretched measured move, right, to another. So I don't know that I'd be betting the whole farm that we're going whole hog higher, right? This is a big area of resistance right here at this 4176 area in the S&P. I think we may have some backing and filling work to do as we trade sideways. Let's take a look at go back to the dollar. So high 109, not sure we're going to see that in the next month. I would argue that we spend some time right around here. So I guess it's good for, obviously most people that are listening to trade on a smaller time frame. Obviously the daily charts that show, whether it's 5 minutes, some sort of tick chart, or a 15-minute. Probably should spend some time in this area. So I'm not going to go into a lot of this. I've shown you guys some other currencies. I do want to take a look at what's going on in crypto, because we've seen a pretty decent lift. One could argue, albeit sloppy, one could argue that we've spent a solid period of time basing down here for some sort of lift higher, right? Higher low, right? If we have some sort of pullback, higher low. In at least the shorts case, right? They're looking at this bar and this ensuing vol that surrounded these moves and saying, we're not going above that. So remember, max pain always is the thing that the market wants to hurt the most people. So a rip up through this area into this would be probably the max pain trade, at least from a just from a pure price action standpoint. That also takes us to a moving average. And outside of the Bollinger Bands too. So maybe we got to spend more time. Who knows? Maybe we fall back into this sideways trade and continue to build a base and just auction to the highs, to the lows. I did want to take a look at GBP CAD, just so you guys can see. Still essentially down here, facilitating back and forth trade across the range. There's a move higher in gold. Some of the minor stocks that are associated with this just had some absolute rip days on Friday. There's a euro US dollar. Of note is the center point here. It's this red line. This is what's the point of control. This is from a volume perspective. So if one can reasonably say that the volume coming in from FXCM on this is accurate, aggregated, and consistent, which I would argue it's just not, then the center point of volume is right here. And more than likely, if the dollar continues down for some extended period, this chart actually shows you potentially what could be that area of magnetism I talk a lot about, which is almost a perfect 50% retrace of this entire zone right around here, right? But the break point is, it's almost like there should be one of these squeeze zone lines right here, but imaginary line in your head, one spot 0.3-ish area. That's current resistance. So, know all that fun stuff. Wish everybody a great trading week. I'll tell you, the conversations I had last night with one of the best developers I've ever met, and that's Dasan. Some pretty good stuff coming in, both automated and manual trading land. I'll tell you, it's these these strategies are not without they're constantly making updates and stuff. And, when you're in the very early days of this, kind of like the pioneers and the settlers and the Industrial Revolution that took place in this country, there are always going to be setbacks. But the key is to learn from the setbacks, which they have, and they talked exhaustively about last night, and the fact that, looking to make it better. So I would say stay tuned. Good things to come. Everybody have a great week. My name is Steve Federal. Good night.